Google is up over 50% over the last 12 months. We can see as well it is right there towards its 52-week high that it hit just last week. And we can see analysts are still giving it a buy and a strong buy rating. Now, when we take a look and compare its PE gap on a trailing 12 months against the rest of the Mag 7, we see it is one of the cheapest at 27.19. When we take a look at it on a forward PE, 23, it still looks incredibly cheap. One of the biggest opportunities to buy this company for some very strong growth over the next few years. We're going to discuss this in today's episode, as well as running it through the valuation model to get to our own intrinsic value as well as our acceptable buy price. We'll also discuss Wall Street's forecast over the next 12 months. And when we jump into the DCF model, we're going to run you through 3 different forecasts, a low, medium, and high, so you can also understand where these predictions and forecasts are coming from. We will also briefly talk about whether or not they will initiate a dividend over the next 12 months, talk about how that looks like in terms of the yield as well as the payout ratio, and we want to draw to your attention a few highlights from their AI Investor Day that they just had last week, talking about a lot of new features for this company. Now, we can very quickly look at the historical performance. As we mentioned, the forward P is at 23. Over the last 12 months, very strong. It is up 51%. Over the last 10 years as well, up 481%. We do note it did dip to around the mid-80s not too long ago, and this is one that has seen some tremendous strength from that point. Now, when we take a look at this company, a few positives as well as a few negatives, we do want to touch upon their share-based compensation. Now, in terms of their top line, we see some strong growth over the last 10 years, going from 66 billion in December 2014 to 307 in their latest annual accounts. And we can see some very nice growth year on year, which is very strong. But when we do touch upon the SBC, you will understand why we do find this is a little bit strange for this type of company and this magnitude. Now, bottom line, also we can see it has been increasing. 14 billion in 2014, 74 billion in their latest annual accounts. And again, similar to their top line, some tremendous growth over the last 10 years. Although we do note some inconsistencies where we see a drop 2016 to 2017, as well as 21 to 22, whilst the top line was also increasing. Nonetheless, their revenue and bottom line net income is looking strong. It is increasing at a strong rate. We'll come on to the percentages of that very soon. Now, their cash versus total debt, a quick health. They hold a lot of cash and short-term investments on the balance sheet, 62.6 billion in December 2014. Latest annual accounts, 111 billion. So over the last 10 years, that cash position has increased substantially into what was already a very large position not too long ago. Now, in terms of their total debt, numerically and directionally, what we can see here is it has increased as well substantially from 8 billion in 2014 to 30 billion in their latest annual accounts. Now, that is still significantly lower than their total cash, and even though it has increased over the last 10 years, we can note when we do look at their metrics, their net debt to EBITDA as well in specific, it will essentially be 0. This is a very strong balance sheet. If they wanted to pay off all of their debt, they could in one day. Now, in terms of their performance versus their competitors in the interactive media and service industries, we have Meta Platforms, Tencent Holdings, Baidu, as well as a few others, also in the Chinese market. Over the last year, we can see now Google is up 51%, the second best performer, largely behind Meta, which has had an incredible recovery from the drop that we saw not too long ago. Over the last 5 years, again, very strong performance, the second best, again, behind Meta. And it has become a common theme. It has been the second best performer over the larger period, again trailing behind Meta. One thing we would say with this is that just because they have had a fairly strong last 10 years, it doesn't necessarily mean this will be the same case in the future, but as always, something just to consider within your own investment thesis. Now, will they pay a dividend? Will they not pay a dividend? We have seen quite a few companies this year, as well as the back end of last year, start to initiate a dividend. Will Alphabet now do that? Well, what we want to take a look at is what would the yield be if we are thinking about this company essentially initiating a dividend. In terms of the payout ratio, when we look at the likes of Meta, when we look at the likes of Alibaba that did initiate a dividend, we can see their payout ratio was between 10 to 20%. If we go on that basis, based on Alphabet's forward earnings per share at 684, the expectation will be that the yield won't be massive. Again, it isn't something that we are expecting it to be above 1%, in between 0.43, 0.87, somewhere in between there. Now, it will be interesting to see. They hold a lot of cash on that balance sheet, but when we look at the return on invested capital, it is very high as well. So it depends how they do want to return that cash to investors, whether that's through share price appreciation or whether that is through initiating a dividend. Now, in terms of other metrics, the growth grade and underlying metrics from this, we do get a B rating here. Now, let's take a quick look. Revenue year on year, just under 9%, a lot better than the sector median of 2.4. Forward looking, they are expecting double digits. Again, a lot better than what the industry leaders are initially expecting. And we can see that is a common theme across a lot of their metrics, although we do know it isn't as high as maybe we would like to see, hence why we get that B rating overall. In terms of comparing that to their profitability, well, for this, they get an A+. Gross margin, 57%, marginally higher than the industry, around 49%. When we look at both EBIT margin as well as their bottom line net income margin, a lot of strong metrics that we can see, significantly higher than what the industry leaders have, around 2.3 on the bottom line and about 8.3 on the EBIT margin. Now, we did run through this already, but again, the Magnificent Seven are trading at a historical PE much higher than Alphabet, bar, as we can see, Apple, which is around Google's 27.19. So this is one of the cheapest in the Mag 7 for your consideration. As we can see here, we have the likes of Tesla around 40, Nvidia around 74, Microsoft at 38, and when we take a look at Amazon, it does sit around 64. So factor that into your investment thesis as well, and when we look at our margin of safety, you can either increase that or decrease that depending on your future expectation. Now, in terms of insider ownership, under 1%, 101 million worth of shares sold just over the last 12 months, 10 different times or 10 separate occasions, whilst we only see around 9 million worth of buys, and we can see quite frequent as well. Quarter 1 of 2024, 37 million. Quarter 2, 4.12 million. And when we take a look at these names, we can in fact see the CEO on the 3rd of April, not too long ago at all, sold 22,500 shares for just over 3.5 million. Now, it isn't necessarily a massive red flag. You wouldn't even say this is a bearish indicator. We don't know why he sold, personal reasons, financial reasons. But again, we do want to point that out here so you can make your own decisions, your own judgments and estimates moving forwards. Now, when we look at institutional ownership, we see 40%. We see a fair amount of sales, 53.5 billion. During the same period, over the last 12 months, we do see a little bit more buying. Now, if we're looking at the latest quarter, Q1, in fact, a lot more buying, 581 million versus 155 million worth of sales. And we can also see over the last two quarters in 2023, Q3 and Q4, there was more buying than selling. So we have insiders selling, institutions buying. Again, never copy what institutions or insiders do. Do your own due diligence, but it is always quite interesting to see this. And again, you can factor that into your own decision making. Now, one thing we wanted to point out is their earnings, how they normally fare on their earnings. Before we look at that, we can look at their more recent earnings in December 2023. Now we can see top line growth, double digits, 13%. Bottom line, very strong, 52%. And their earnings per share up 56%. Net profit margin, as we went on, they do have a very strong net profit margin, especially when we do factor this into the industry median, and we can see a few other metrics. Now, what we wanted to point out, first thing, their earnings is due in a couple of weeks, so that will be interesting. We will deep dive on that. But over the last 4 quarters, as we can see, they have had a double beat on both earnings per share as well as their revenue. So that is quite an interesting thing to note with Alphabet. They are typically expected by the market to beat on both occasions. So it will be interesting to see how they fare in their latest. And when we take a look at the numbers, there is the expectation of $1.50 and then 79 or just under 79 billion worth of revenue. So interesting to note that is also lower than what we saw in the last quarter with 160 in terms of EPS and 85.28 billion in terms of revenue. Now, the one thing that I don't like about Alphabet, and yes, not everything is always positive and rosy, what we can see, now you would like to think this might be the free cash flow per share, it is increasing, but no, this is their share-based compensation. what I wanted to highlight here is that we can see 22.46 billion in their latest annual report in terms of share-based compensation. And when we take a look at their revenue, what we can see in December 2023, 307 billion. So nearly around 10%, or just under 10% of their top line, they are essentially paying in terms of share-based compensation. On top of that, it is increasing year on year. It is getting very high. Now, you may say that's not high at all, but let's compare it to the likes of Apple, Microsoft. So we have Alphabet 22.46 billion in 2023. When we look at Apple, it's still increasing, but we have less than half of that at 10.8 billion. When we take a look at Microsoft, again, 9.6 billion, so it is a lot lower. So we are seeing Alphabet, they are a very strong company. They're increasing their top line. A lot of their metrics are positive, as we're about to see, but we can inevitably see that their share-based compensation is increasing quite significantly year on year, and that is a tremendous amount, 22.46 billion in FY23. Now, let's take a look at a few features from the AI day that they had just last week. It was their annual event called Cloud Next, and let's take a look at some of the new features that is integrating AI into this business. We have some updates to the previous Gemini, as we can see here, in terms of new ways for the AI to hear and see images and read text. As we can see, this was one of the issues we did have in an earlier episode, where if you want to go check that out, they were releasing images that weren't correct and there was a lot of uproar. In fact, there was even talk about the CEO stepping down, although a lot of people would still like to see that. And we can also see here they have new features for using AI to create and edit content. So there are some things which you could argue isn't massively different from what is already out there in the market. A lot of competitors who are also doing a lot of this, who are actually in fact specifically looking at the software itself, like Adobe and a few others. But again, this is something that they are bringing to investors who are looking for new ways for Alphabet to increase their top line. Now, just to let you know, we have released our latest free weekly article. We do run through 10 stocks with a lot of upside. If you want to gain access to this or any of our other articles, all completely free, do click on that pinned comment below and sign up. Now, in terms of this company, yes, we don't like their share-based compensation, but their metrics are very strong. We can see their free cash flow has been increasing year on year over the last 10 years, expected again to increase into 2024. Their top line is also increasing double digits every single year, bar the more recent year. So it is looking very healthy. It is continuing to climb as we would expect from this tech giant, going up from 66 billion 10 years ago to 307 billion. Whilst we haven't covered it in today's episode, they are doing share buybacks as well, as we can see from this graph. In fact, starting from 2019, they have been consistently buying back shares year on year, which does return that excess cash to investors as you do gain a larger control portion of the company. Although we do note they did also go through a period where they were issuing equity. Regardless, the net position over the last 10 years has been some share buybacks. They also have some very high return on invested capital numbers, in fact the high 20s over the last 3 years, which is one reason why we may not see a dividend for this company being initiated. They may continue investing that capital at a very high rate and see the increases in their share price as opposed to initiating the dividend. However, do let us know below what your thoughts are. We also see some nice operating margin, in fact operational efficiency, as it has increased over the last 10 years, and the free cash flow year on year very, very strong, consistently above the minimum 7% that we do target, and that would be attractive to potential investors as well as those who are considering adding to their position. As we spoke about at the beginning of the episode, net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, it is an even one, meaning as we said earlier, it wouldn't even take them one day to pay off all of their debt net of cash on hand. They do have a phenomenally strong balance sheet with a lot of cash sitting there that are essentially getting interest on top, as they are majority of it invested. Now, in terms of their valuation, and as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. The first model that we do use is the multiples valuation model. We have companies in a similar sector and size. Average PE multiplied by the EPS of Alphabet to get an intrinsic value showing some very strong undervaluation. But do bear in mind, we don't look at any of these models in isolation. We then have the discounted cash flow model. Now we have the free cash flow year on year. On average, it has grown by 24%, which is very strong. We have forward looking estimated 12% lower than analysts, lower than management, and in fact lower than the previous year. So we do try to be more conservative. With our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get our second undervaluation signal. Now, for those who believe that that is too low and want to go for around 14%, you can see as per below, this would get to around $245. So on the DCF model alone, it would be 56% upside. If we went to 16%, as you can clearly see, but we will recalculate that, you would get $281 and again 78% upside. So it does really depend. Let me know your thoughts below. We have, however, gone for a 12% rate. And as always, you can click on the pinned comment below to grab a copy of this model and therefore recalculate it. Go and analyze companies in your own portfolio or on your watch list to get your own intrinsic value as well as acceptable buy price. So in terms of the intrinsic value for today's episode, it is purely the average of these two models, coming to $204. As always, we do start off with a margin of safety of 10% and execute if it meets the three criteria: a wide moat, strong financial metrics, and good forward-looking data. And then we keep going till it's near the current trading price, and we can see for today's episode, it isn't quite yet a 25% MOS level, but on our estimates and judgments, it's between 20 to 25%. In terms of Wall Street, well, their forecast over the next 12 months, they see the share price going to $185. They see 17%, and as we said at the beginning, they do believe this is a strong buy now. But as always, do let us know your thoughts in the comments below. Is Alphabet one you are continuing to add? Maybe it's one you hold indirectly via ETFs, or maybe it's on your watch list waiting for a certain price. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Let us know your thoughts below, and as always, we'll see you all on the next one.